Paul Cavey, thanks very much indeed for joining us.
Give the government some confidence. Think about the economy more broadly going well for China. The more interesting story is you look at TSMC.
Hello, I'm Paul Cavey from East Asia Econ. Keener audience members, if there are any, might remember that a couple of weeks ago we were talking about this comparison between China today and Japan in the 1990s. It's probably one of the most popular ways of thinking about China's economy as yields in China fall below Japanese yields, which is one of the ways you can think that China is following the Japanese path. Now, if you remember, a couple of weeks ago, I used this framework from the Bank of Japan that was published at the end of December, looking at the experience of Japan over the course of the last 25 years, which is really a very good guideline, a very good framework for thinking about where China is today, in terms of it identify specific things that caused the decline in Japan. Now, 2 weeks ago, we looked at the demand side issues. So as I said, there was these three buckets of things that the Bank of Japan identified. First is the demand side, 7 different things there. Things like lending standards tighten, corporates become net savers, Japan can't keep up with globalization, right? Those kind of things. In that, there's some things which are similar. So demographics are similar to Japan back in the day. But still, even with that, probably China in all of those things only gets a score of about 30%. Now, today I want to continue the analysis, but look at the second 2 buckets of things that the Bank of Japan identifies. So the first of those are supply side issues, and the second is a bit more idiosyncratic, sort of cultural, institutional. So I'll look at those 2 things today. So to start with that, the supply side. So we talked about the demand side before. Now we're going to talk about the supply side. So one of the things here is currency appreciation. So there was this sort of increasing downwards pressure on prices from the supply side is the way that the Bank of Japan talks about this. And one of the things that caused this was currency appreciation. And I've talked about this before, and I think it's something which is really not appreciated enough by a lot of investors looking at China today. When you look at what happened with Japan in the 1980s and 1990s, the currency appreciated massively during the 1980s because of the pressure of the Plaza Agreement, the pressure from the US to redress global imbalances, sort of similar to some of the rhetoric that comes out of Washington, D.C. today. But interestingly, even though the economy stopped in 1989 and asset markets bubble burst, equity market comes down and so on, the currency didn't stop appreciating. So you go through the first half of the 1990s, and the yen appreciates by another 60 to 70%. This is a time when the economy was already slowing massively because of the bursting of the bubble. And effectively, you have this another very strong monetary policy tightening coming through this big move in the currency. So why does that matter for what's happening with prices domestically? Why does it cause deflation, which was one of the big issues of Japan's economy and the malaise that Japan has suffered? Obviously, because if you're having a big appreciation of the currency, you can expect that prices start to fall. So this supply side pressure that the Bank of Japan that talks about, one of the reasons that this happened was because of currency appreciation. Now, if you look at China today, again, this is just not happening. So the currency is actually a little bit, it could probably be a bit weaker than it is today. If you look at interest rate differentials, they continue to suggest that CNY against the dollar should maybe 7.5, 7.6 or thereabouts. So maybe the currency is a little bit strong, but it's not really strong in a fundamental sense. And in real effective terms, the CNY is actually depreciated by about 15% over the course of the last 2 or 3 years, and is cheaper now than any time since 2014. So it's really like when you think about Japan and China today in terms of currencies, it's really like chalk and cheese. It's completely different. So there's no comparison here. China is not falling into that same trap that Japan had 25 years ago. So that's one point when thinking about the supply side. The second thing is, again, and a bit like thinking about when we think about demand side, that you have a tightening of lending standards, that feeds into slower investment. There's this feed through into the economy. When you think about currencies, it's a similar thing. So when the currency appreciates so much, one of the things that starts to happen is companies move capacity overseas. Now, that might be from a position of strength. Sometimes that can happen and companies still invest more domestically. But we know from Japan that that's not what was happening. So companies were investing more overseas and they're investing less in Japan. This was because Japan was becoming much more expensive relative to the rest of the world. And so to remain competitiveness, companies had to put their manufacturing overseas. So this was like a double whammy that faced the domestic economy. We can see that in global market supply data. So when you look at market share data, so when you look at Japan from 1990s, where global market share was increasing quite quickly, After 1990, it just suddenly stops and starts to come down. You look at China, again, there's no evidence of this at all. The export numbers from China are sort of absurdly strong, really, over the course of the last 12 months or so, particularly in volume terms. So China's continuing to really kill it globally in terms of market share. There's no sign of competitiveness coming down. There's no sign that companies investing overseas is reducing domestic capacity. Like, none of this is showing up in China. So again, we've got these so far 2 points on the supply side for Japan versus China. And on none of these things does China look similar at all. The third point related to the supply side and related to currency appreciation is, as this started to happen and the yen became more and more expensive, one of the things that happens is the economy starts to attract more imports. So not only do companies face more competition overseas because their export prices are facing competition, domestically, you get a lot more imports coming in from overseas. And obviously at this time, particularly from China and the rest of Asia, because these economies were doing quite well. And you can see that in the import data. So import penetration in Japan really starts to go up from the 1990s. So this is like both competition for domestic companies, and because its prices coming in from overseas, it's a lot cheaper than the stuff that's being produced in Japan today. This is another reason why Japan got into difficulties, because import penetration increased. In China, again, that's just not happening. In fact, if anything, I mean, it's remarkable when you look at the export and trade numbers from China. Export numbers are through the roof. Imports have done nothing over the course of the last 2 to 3 years. For an economy that's still growing, import volumes haven't gone up at all. So if anything, there's reverse import penetration, right? China's importing even less from the rest of the world than it was before. This is clearly not something that's causing any deflation that China might have. And then the final point, what's the impact of this in terms of thinking about prices? The final point to make about this, the final point on the supply side is about domestic pricing. And obviously, when you look at this kind of without considering any other factor, you might think that there's some similarity. So Japan back in the 90s fell into PPI deflation from 1990 going through to 1995, which didn't really reverse until very recently. So a very long period of PPI deflation in Japan. Now in China recently, prices have been falling as well. And this is one of the things that a lot of the media uses to say that China is following the same path of Japan. But actually, if you look at globally, everywhere is having deflation in terms of PPI right now. And there's very little, for example, to differentiate between PPI deflation in China today and PPI deflation in the US. If you look at Japan in the 1990s, prices were falling in Japan, even though they were rising in the US. So there was something very idiosyncratic going on in Japan, which again isn't being seen in China today. So if you take these four things, exchange rate appreciation, shift of production overseas, import penetration, and finally falling prices, the only one of those four things you can point to that's happening in China today is falling prices. And even though that looks similar, it's not really clear that it's at all for the same reasons that prices were falling back in Japan in the 1990s. So again, when in our tick list of thinking where China might be the same, China again doesn't score very highly here. The final bucket of issues that the Bank of Japan talks about then is sort of more of the idiosyncratic stuff. So this is a bit more about where Japan and China sit relative to other economies and how the economies work in sort of institutional cultural terms. And there's one very clear way of thinking about this. It kind of like sets the scene, if you like. And that's the price differential between Japan and the rest of the world in the 1990s and China and the rest of the world today. Now, the Bank of Japan has a very nice a very nice chart of this. And this is basically looking at the price level in Japan back in the 1990s was 2 times relative to the rest of the world. Why was that? Because Japan in the 1980s was a very expensive place, and the yen continued to appreciate in the 1990s. And it's sort of interesting, this, right? So this memory lives on. So even in 2015, when I was going to Tokyo to live, to work in the Tokyo office for a while, as I was leaving London to go to Tokyo, a lot of people were saying, but isn't Japan very expensive? And this whole memory of how Japan used to be, because it was a very expensive place for a long time, that memory really lived on, even though property prices by 2015 had been falling for 25 years. Like, it wasn't an expensive place at all relative to London. And yet that memory lived on. Now, if you think about where China is today, it's completely different. There's no sign that the currency is overvalued, that the domestic price level is too high, that China is being priced out of global markets. There's just no evidence of this. It's not similar in any regard. So this is one reason, I think, another reason to start to think that China's unlikely to follow that same Japanese path. The second thing, so that price level is different. What does that mean? What's the feeder of that into the rest of the economy? In the same way that lending standards tighten, manufacturing investment falls, or the currency appreciates and that pushes down prices. So when the price level is very high to begin with, what's the feed through from that? Well, companies have to start to cut costs. How do they cut costs? They cut costs in large part by trying to do something about labor supply. Now, in Japan, that's not as simple as saying that companies laid off workers, because in Japan, there's this sort of cultural preference for having workers rather than cutting wages, and that's something we'll come on to. But where it did fall out in Japan is because Japan, in the 1980s and up until 1989, it had a very regulated labor market. Not many part-time workers. Most workers were lifetime employees. You got a job in a company, you stayed there forever, and that's how the system worked. So what happened in the 1990s? How do companies save costs? Well, they start to employ a lot more part-time and irregular workers. Like regulation changes, companies find a way around the regulations. They don't want to hire an expensive lifetime employee. They want to hire a cheap part-time worker who they can lay off if they need to. So what you see in Japan is like why the price level was so high was in part because the labor market was so regulated. Therefore, there was a way to deregulate the labor market and cut costs. And that's what happened in the 1990s. But as a result, you see pay coming down for ordinary people because they're not having those same protections they had when they were working in lifetime employment in Sony, one of these other bigger firms. Now, when you look at China in this respect, that sort of regulation of the labor market, like it's not the same at all. Right? The labor market in China is not regulated to that degree. It's because of that you have 300 million migrant workers in China running around trying to find jobs in construction sites and restaurants in bigger cities and this sort of like second class of workers, if you like. That has existed in China throughout the course of the last 30 years. Now, probably you could deregulate the labor market a little bit more. If you're working in the state sector in China, you are much more protected than if you're working for the private sector, and you're certainly much more protected than if you're a migrant worker. But it's not like there's this whole regulated market where everybody is protected. Like China's not like that at all, which is one of the reasons why the price level is much lower, and one of the reasons why China is more of a competitive economy today than Japan was back in the 1990s. The other point about this, and I think this is important for thinking about China today, is it's also sort of the way the economy works, the way people like their country to function. So again, in Japan, one of the big important points about Japan was that there's this cultural, institutional preference for keeping employment and not rather than. So in the US, when there's a problem with the economy, people tend to get laid off. In Japan, when there's a problem in the economy, companies tend to keep their workers and cut their pay. So one of the reasons why Japan ends up with deflation is because wages are being cut. Like unemployment never rises that much. There is some unemployment relative to where Japan used to be, but unemployment never rises that much. The problem in Japan is that the only way that companies can keep their workers is by cutting wages. Now, think about China. Is that the same in China today? You would have seen a lot of people would have remember the headlines back in 2009 when it was the global financial crisis, and headlines saying that 20 million workers were laid off by factories in the course of a few weeks. Like that's the migrant workers in Japan, in China. This big group of workers who really don't have any protection. The private sector over the course of 2021 to 2022, laying off a lot of workers in China. Like this is not protected workers. It's not the same workings of the economy in the way that it works in Japan. So again, like when you go through these list of idiosyncratic things, like we went through the list of supply side stuff, you've got a price level, which in Japan was very high. It's not true in China today. You've got a situation where you can deregulate the labor market. Again, not the same in China today. And you've got a situation where companies prefer to cut wages rather than cut workers. Again, not the same in China today. Now, a final point about this is, and this is where you get to sort of like the way that the economy works as a function of being in deflation for a long time. And this is a point that the Bank of Japan stresses very strongly, that in Japan, because you had a situation where wages were coming down and where prices were falling, it actually made it very difficult for companies to start to raise prices. So you end up with this deflationary equilibrium is, one way of thinking about it. Prices are falling because prices are falling. And in that situation, if you're one company and you have a great product and you want to raise prices, you can't do it because nobody else is doing the same. And so if you raise prices, your demand is suddenly going to fall off. So you end up this situation where there's a deflationary equilibrium, which means you end up with more deflation than you otherwise would have. Now, again, in China, so it's sort of this idiosyncratic stuff, right? The way the economy works. Because Japan was on this road where there was a very high price level to begin with, companies didn't want to cut workers, they wanted to cut wages, prices then start to fall. That creates a sort of, it's not really a spiral downwards, but it's an equilibrium where it's very difficult to break out of. Like those things aren't happening in China. There isn't that causation of events. So again, when we look at both the supply side stuff and think about some of these idiosyncratic things, it's actually very difficult to think that China is the same as Japan back in the 1990s. So if you take all of this together, like over the course of these two videos, like I've gone through this bunch of things, right? Like thinking about demand side stuff, supply side issues, and finally thinking about some of these idiosyncratic things. Now, again, my sort of simple, it's very, subjective, and you might argue with this, but I think the framework is very clear. So you can sort of choose your own scoring. But you can go through this and pick out 15 different things where we can rate China as on a scale of 2 to 0, where China is either very similar to Japan back in the 90s or very different, and then it gets a 0. On that scoring out of 30, I reckon China only gets a 9. So it's only about a 30% score. So this idea that China is definitely following the Japanese road, I think very much misrepresents where China is today. It's not to say that China doesn't have economic issues. Clearly, the property market is a problem. Clearly, consumption, as we'll talk about in another video, is also a problem for China. But it's not the same thing as saying that China is going to have if you look at Japan's statistics, the economy stopped growing in nominal terms during the 1990s. There was no growth at all. Now, that's what the market was pricing in terms of yields falling in Japan. That sort of thing is not what's happening in China today. So I think it's important to differentiate that, and it has real market implications, because I think in somewhere like China, it becomes very easy to argue today, or very reasonable, I think, to argue that interest rates have probably fallen enough that they're unlikely to fall much further, because it's not the same thing that was happening in Japan back in the 1990s. Now, again, my name is Paul Cavey. I run a firm called East Asia Econ. I try to look at all these issues, these kind of regional issues that are facing the economies, with a lot of historical analysis as well. I hope you find the videos interesting. Please subscribe. And also, please check out my website, eastasiaecon.com, where you can find a lot of the data. It can be downloaded, and a lot of the charts are also available there. So thanks for watching.